Hi and welcome to the FX Street webinar. Okay, my name's Ian Coleman. I'm one of the analysts and traders at firstotrading.com. Okay, we supply analytical reports on a daily basis for FX majors, crosses, stock indices and interest rate futures. But we're going to talk about money management today. I can see we normally get about 60 people that attend the webinars. I can see there's a lot less than that today. Now, I don't know if that's because it's the run up to the New Year break or because people don't regard, or traders don't regard, money management as being a major factor. Again, it is. It's as important, if not more important, than technical analysis. If you don't have decent money management, you can become a car crash, basically. If you don't know where your risk reward is, then your account can soon get heavily depleted. So today we're going to talk about capitalization. We're going to talk about trading versus gambling. We're going to talk about drawdowns on your account, how much you should risk per trade. We're going to talk about managing trades. Okay, that's not just buying, say, in free units and trading out. It's also trading in, so fading in and fading out of positions. And we're going to talk about risk reward. I'm just seeing from Jano there that, is there a problem with the screen? Can everyone see what's on there at the moment? It should be money management in a circle. Some can, some can't. So capitalization, how much to trade? Okay. This differs greatly on differences of opinion. Some people start with quite a low amount in their trading account. Some people start with sort of, a few thousand, and some people start with a lot more than that. It's how much you can afford to lose, basically. How much is your disposable wealth? And I'm not talking about putting all your savings on the line. Okay, you should never borrow to trade. Starting capital we've mentioned. You should, in my belief, you should start in small, especially if you're a novice trader. Okay, start in small, start building up your trading capital, and then increase your trade size. Okay, this is going to be awful. What's the capital? Okay, so basically a 10% loss of capital would require 11% gain for you to get back to break even. I've just done a chart here so you can see how bad it can become. Okay, a 50% loss of capital, you'd have to get 100% improvement on your account to get your account back to break even, and obviously 90% goes all the way up to 900. And there's a graph there which just shows you how severe loss of capital can be. So you should really only look to risk, as Jose said there, you should only really look to risk around 2% of your working capital. You can increase that if you've got a system that's working well. You can move it up to, say, 3-4%. And as Philip is saying, increasing position sizing as your account increases. I had this all planned out earlier. So risk reward. Okay, very important. Your risk reward on any trade should be a minimum of 1-to-1. Okay. You should, as your account builds, have a risk reward curve like this. So here's, I've taken a typical trade. Okay, we've got a downtrend. This is actually off a daily chart. That's why the stop loss is so high. Chart formations, okay, are the same in every time frame. I don't go all the way down into a 5-minute chart to look for trend. Okay, I'd take my trend off daily, an hourly chart to look for a bias, and that bias is produced by candle formation. Okay, if anybody's been to one of our seminars, webinars before, I put a lot of emphasis on continuation and reversal candles. Okay, price action at areas of support and resistance. So here, okay, in a downtrend, and we get a bullish engulfing candle off the bottom. I used to be perfectly honest, years ago, I developed a trading system. Believe it or not, it had over 40 winning trades in a row, and that was from trading basically into losing trades. What I used to do, and I'm not going to bore you too much with it, what I used to do is I used to overlap currency pairs. So say if I wanted to look at sterling dollar, I'd overlap sterling yen and dollar yen on top of each other, okay, on an hourly chart, and then I would look basically for gaps to open. And what used to happen, sterling yen would go in one direction, dollar yen would go in another direction, and that gap would then basically tell me that sterling dollar had gone either too high or too low, and I'd work out how much the maximum gap became, and I'd look to either buy the gap or sell the gap, depending on which way around it was. And if it went against me, then I'd look for another another level. I'd then increase it. It worked extremely well because we had trending markets. Okay, as could be the way that the system worked. Obviously, we had non-trending markets. Okay, so obviously with it going, sterling dollar just going up and down, okay, consolidating. I was hitting the top, hitting the bottom, hitting the top, hitting the bottom. Basically, the way that it blew up, as with a lot of trading systems, is that the market started trending, and this gap just got bigger and bigger and bigger. So, yes, you can scale in to losing trades, but as Jonty says here, as long as you know your maximum risk, okay, never get to your maximum risk. A rule of trading is never move your stop unless you've got an extremely good reason to do so. Okay, you have to know your risk reward as you enter a trade. So if your maximum risk is going to be, say, 3%, as Jonty said there, keep it at 3%, because in a high trending market, it will just keep on going. Okay, so here we've got a bullish engulfing candle. Okay, so we enter at the close, and this is just one example that we're going to use today. Stop loss below the low. Okay, I always put it a few pips below the low. I don't want to get spiked on a tree shake or whatever you want to call it. So it's always a few pips below the low. So here we've got a 223 pip risk. Okay, and our first area, or our first risk reward level for 1-to-1 is at 135.84. Just trying to make that bigger. So you want to basically calculate your risk level. So this is your stop. This is 1-to-1. So as you've bought it, or as you're looking to buy it, what is the area of resistance? Okay, so the previous area of resistance we can see here is around 135.84. So we know that we've got a good chance of 1-to-1 risk reward. If we break above this level, okay, the next area of resistance is up here, okay, which is just below that area, is 2-to-1 risk reward, 138.07. And then we calculate our 3-to-1 risk reward, and it's all the way up here at 140.30. Okay, so how do we manage to trade it? Not onto that bit yet, so I really am losing myself today. Oh, these slides are horrendous. Okay, 3-to-1 risk reward. I just put a chart in here. So there's 10 trades here. Now, if you had 3-to-1 risk reward on every trade, and there's very few that can ever achieve those sort of levels, then if you had 50% winners and 50% losers, if you traded with a risk of $1,000, €1,000, €1,000, or even or even £10 per point, okay, and you were to win every other trade, then you'd have 5,000 in losses and 15,000 in profit. Okay, so you'd have an overall net profit out of 10 trades of £10,000. Okay, 3-to-1 risk reward is hard to achieve, to say the least. Sometimes you're lucky, sometimes they'll just keep on going and bleed, especially if you can get in on a shorter time scale. Okay, I know I said earlier on that I don't use 5 minutes charts for trend, but I do use them for entry levels. Okay, we're going to talk about the dollar Swiss trade that we posted on the Forex Street Net, okay, on the blogging platform earlier in the week, and how that risk could have been controlled. Okay, trading versus gambling. Now basically, if you do not know your risk reward at the outset of a trade, then you're gambling. It's as easy as that. Trading is in the knowledge of money management and targets. Okay, trading your systematic approach that you've developed. Okay, every trader should have a trader's edge. Okay, casinos have an edge. They don't care if you go in there and win $1 million, because they know that out of everybody that trades, everybody that gambles, either on roulette or on slots, they have an overall net profit of around 2.5%. Okay, if you can guarantee that your system will bring you a net profit of 2.5%, okay, it may take you a long time to get there, but that gradual build, you just keep on pulling the trigger. So every time you get your signal to trade, you pull the trigger, you pull the trigger, you pull the trigger. You're going to get drawdowns. You're going to get times, areas where you get more losses than you do wins. Not every system is foolproof. A casino's edge is 2.5%. So basically, out of every $100 that is spent in the casino, the casino will make $2.5. And it just goes to show you how much money they do make is how much money obviously turns over in casinos. But an average casino's edge is 2.5%. Not that I'm into gambling. I do play poker. Okay, so your risk should always be defined before your entry. Let's pull this back a bit. Okay, drawdown. Let me zoom in. I hope you guys can see that properly, because if I zoom in, it goes a bit faded. Okay, we've got here 2% risk. Okay, so we've got an account with 20,000. Okay, at 2% risk. How do you avoid stopping a trade before it hits the target level? My loss is always bigger than my wins. We'll talk about that. We'll talk about moving up stops. We'll talk about reading candles. Okay, reading the strength of the trend. You've got to try to, professional traders, I've got a lot of mates who work in the futures market. I was a broker for 12 years, so I know a lot of bank traders. And they call it getting a bleeder. Okay, and that's what you want. You want something that hemorrhages, basically. So you enter a position, you get it to break even as soon as possible. Okay, and then you let it ride, and you have a target level. If it looks like it's going to surpass your target level, then you can keep on moving your stop up as it gets up towards your target level. That's really what you want to be looking for. In a lot of, 90% of my trades, I would take in 2 units. Doesn't matter how small the units are, but I'll execute in 2 units. I will then try and get my first unit off at a specific level. I will then try and get either my stop move my stop up so it's at break even, or my stop to entry, so at least I'm guaranteed that I've banked something. Okay. If you only trade in a small unit, whether it's if you're spread betting, whether it's a pound a point or a euro a point, if you can't scale down, if you can't pull one off, shouldn't really have said that, if you can't take a unit off, then you're stuck with that one unit to try and manage, if you like. Okay, we're going to talk about managing the trade in a minute, but you really want to have more than one unit on, or if you're buying one unit, then you really need to look at building, so you at least have 2 units on as it goes higher. Okay, so we improve our average. Okay, so here 2% loss, £20,000 dollar euro account. Okay, these are losing trades. So as we move down and we keep on risking 2%, okay, obviously it doesn't keep at 400. As our account gets depleted, okay, after 20 trades, we're risking 300 per trade, and our account balance is about 1,500. If we were to risk 10% per trade, okay, it's 2,000 downside per trade. And you can see by the time we get down to 15 trades, we've only got 4,500 left in our trading account. Okay, so 10 losing trades, we've got 3/4 of our trading account left. 2% risk, we've got we've lost 3/4 of our account. 2% risk, we've only lost 1/4 of our account. Okay, so it's very important that you don't put too much of your hard-earned cash on the table at any one point. And you can see by the graph here, okay, the drawdown here is quite mild. The drawdown here is pretty drastic. And if you think about what we talked about back here, about the loss of capital, to try and get this amount of cash back into your trading account takes a lot of achieving. Okay, so managing the trade, building the trade. So here we talked about this entry. This is Euro Dollar Daily chart. So we've got our risk reward levels. So how do we monitor the trade? Okay, so here, next slide. Pull it in, sorry about that. So as it moves up, so we move up towards 135.84. So as it gets to this level, okay, we want to then be moving our stop loss up to entry. Okay, it moved down, spiked through twice through our entry level, moved up, and then it got to this area of resistance, our first area of resistance. So at that point, we want to be pulling in the stop to break even, or if we've got 2 units on, we want to be taking 1 unit off, and then the second unit to break even. And then we've basically got a free trade. Okay, if you can, I'm going to try and move it over. No. If you can see here, which is probably difficult with that blue line in the way, there's an inside Arami candle. Okay, inside Arami candles are shows of investor indecision. So really, when you're looking at that, you really should be starting to worry about leaving your stop too wide. So you want to be scaling your stop up. Okay. So here we just said there's an inside Arami candle here. Okay. Actually doesn't take the inside Arami. Okay. It's a show of indecision, but it's not a reversal candle. An inside Arami is only a reversal candle on the break of the previous candle. So here, you can see on this candle, we move up, all the trading in that hour or that day is inside the previous candle's range. Okay, and that shows you that there's indecision in the market. As it breaks through the open of the previous candle, Okay, that is the signal that we're getting lower. I'm going to answer all these questions when I get to the end of these 4 or 5 slides. So inside Arami, stop to the base because we don't want it to break lower than the inside Arami. And this is our entry level. So we know we've locked in profit here. Okay. And it breaks the high. Okay, we've got the resistance level. It breaks the high. We move the stop again, money management, up to the candle break point. Okay, this candle, to the low of that candle. And we're then looking at the next area of resistance, which is around at 138.80. Remember what our risk reward was when we were talking at the top. Okay, just scooting it back. Okay, 138.07 was our 2-to-1 risk reward. So we know if we're getting up towards 138.80 that that we're going to be achieving 2-to-1 on this trade. So we're moving the stop up. As I said, this is previous area of resistance. There you go, 138.77 is not a bad guess. And as it hits this area of resistance, we then want to be wary of pullbacks. Okay, so keep on moving your stop loss up to the base of your candles. Basic trading, okay, obviously in an uptrend, if we broke this down into shorter time frames, we would see intraday dips, okay, and we would see higher highs and higher lows. So higher highs and higher lows tell us we're in an uptrend. And every time we get a higher high and a higher low, we don't want that sequence to break. Okay, so we're placing our stop loss below the low of this candle, or on the low of this candle, as we're at an area of resistance. So we've got our 2-to-1, or near enough 2-to-1 risk reward here. Can everybody else hear me? The mic's still reading that I'm on. Great. And then we get a bearish engulfing candle, okay, and we get stopped at 137.21. So that is the basics behind trying to bleed, if you like, one unit, okay. If you can't afford to put multiple units on, and you can only trade in one unit, then you need to be moving up. You need to be monitoring your trade. You need to be moving your stop as it scales up, okay. Don't move your stop up too close, because as we all know, the markets move in wave patterns, and if you move your stop up too close, you're going to get whipped out on what can be a profit-taking correction. Let's just pull it down again. This is a real pain, isn't it? Where there's a will, there's a way. Okay. Let's just answer these questions. What is the minimum accepted performance in terms of win ratio relative to reward ratio to be profitable? Well, it depends what your system gives you. Now, if your system that you've developed, your trader's edge, gives you an average of 1.5-to-1 or 2-to-1, then you're only going to need to get less than 50% right to be in overall profit. Obviously, if your win ratio is 1-to-1, then you're going to need to get more than 50% right. What do you think of Van Farp's dislike of scaling out? I prefer scaling in than scaling out, put it that way. If you scale out of the trade, I can understand the reasoning behind scaling out. If you put 3 units on, okay, and you've got 3 targets, and you've got 1 stop loss. So if you've got 3 targets and your third target is 100 pips, to make this one easy, and your stop loss is 25 pips, Okay, if it goes directly to your stop loss, you've lost 75. 3 times 25 is 75. If your profit targets are then 25, 50, 100, then if you hit 25 and then to 25, so you banked 1, 50 you've banked 75, because you've got 25 and 75. You have to hit your second target to have to have equaled your risk. Okay, and we've already spoken about how hard it is to hit a third target. So if you are looking to scale out, you're putting a lot of risk on the table at one time, basically. So I personally like to have a view, and I like to scale in and then take it off as it rides, depending on how it rides, basically. Or, as I said, I mean, it's always in a minimum of 2 to start with. Get some in the bank, and then use that banked profit as your risk if you're then looking to scale in. I hope that makes sense. Now, I wouldn't do it on a. How would you look to adjust your trade value amount on a trade by trade basis, or after a week, or after a month? I'd allocate points in my trading account. So if I had $1,000 in my trading account, I'd turn around and say, right, when I get to $1,200 or I get to $1,500, then I'm then going to put this much risk on the table. I wouldn't look at it on a day-by-day basis or a weekly basis, not as a time scale. Time scale doesn't matter at all. What matters is the amount of money you have in your account. Do you do the exact same amount of lots per trade? Obviously, until the account increases, you have to do more. Not necessarily. Hold on 1 second. Too many questions, we're not going to finish. Do you do the exact amount of lots per trade, obviously, until your account increases and you're happy to do more? It's more about where you have to put the stop loss. Okay, so obviously if you've got to put a stop loss at 50 pips, if you're taking a trigger off a daily chart and your stop loss has got to be 50 points, 60 points, 70 points, then your lot size has got to be a lot less. If you're taking it off a 5-minute chart and your stop loss is 20 points or 10 points, then obviously your lot size is a lot more. It all depends. The size of your trade, which you should be able to calculate pretty easy, should all depend on the amount of pips, amount of stop, where your stop is going to be, and then you calculate your 2% risk from there. Don't mind if I move my stop to break even, I don't know. It seems odd that you to like it so much when all traders seem to scale out taking profits when they are there. Not all traders. Bank traders have a tendency to have a view. A bank trader will look to sell and build, and then when he or she's got enough profit, will look to scale out. Retail market's a little bit different. Retail traders have a tendency to sort of lump on at the start, and then are quite happy to sort of take bits off as they go along. But it doesn't make sense to scale out a winning trade unless you get maximum on your trade. If you're on a losing end of a trade, you lose the entire amount of the stop loss. I think we just explained that, though, didn't we? Often heard experts talking about stop loss for money management. This is a massive method, aggressive method, may widely use hit target. Yeah, I always think pips in the bank. I've got a very good pal called Prakash, who's sort of Facebook friend from India, and he will always endeavour to at least get 1 pip out of every trade that he does. So as I said, he'll trade in two lot sizes or 2 units. He'll try and make sure that he at least gets something out of the trade. Do you increase, decrease your position size on the basis of pattern or your series of wins, losses? Depends how confident I am about the trade, whether or not I've got a wave formation, what it's showing me, how far it's trending away from moving averages, where the RSI is the trend strong, is it weak, am I getting dips, is there divergence? It's not really a question for, it differs. I would have looking. Right, this week dollar Swiss trade. We posted this actual chart, I think it was, into the FX Street blog room. Okay, so dollar Swiss. Those of you that like, dislike, detest Elliott Wave, I'm not a great believer in Elliott Wave, but I am a great believer in Fib levels, Fibonacci levels, and I am wary of higher highs, higher lows, lower highs, as we were saying before. So here we get in dollar Swiss an impulsive move up. Okay, it then retraces in 3 waves. Now, as Elliott Wave theorists will tell you, 3 waves are corrective. Okay, 3rd wave should be impulsive, which it is, and it should target around the 161.8% level. Okay, which was here basically. We should put that onto the chart. I think that's 93.60. Now, at that point, I want to be looking for a pullback. Pullbacks in Elliott Wave formation, as we said, are in 3 waves. They're minor. A 4th wave pullback is minor. Now, the reason why this is obviously great, if you can get in down the low here, that is monster risk reward. There was a potential signal here. There was an inside Arami candle with a bullish formation. Your stop loss would have had to been below the low, so that would have been your risk, and your reward would have been up to 161.8%. So, like I said, it's to use fib levels in calculating your risk reward is a very good tool. Okay, a lot of traders use fibs for entries and exits. So here you could have, I didn't, but you could have looked to ride this wave. What I was aware of after the event, okay, as it was riding up here, no, I don't use an awesome oscillator. I just use a fib, basically. So it moved up towards 161.8%. We had a bit of a reaction around there, but no reversal. Okay, then pushed higher, and then comes down in 3 waves. So at that point, as we start seeing this come lower, we want to put a fib from this low to this high. Okay, because we're looking for a pullback between 23.6 and 38.2%. So we can see here our pullback. Okay, so we put our fib on. This is 23.6. This is 38.2. She pulls back towards 23.6. Now, my actual calculation, I don't know why this is. I think that might actually be 25% on this charting package. I had 90. I can tell you. I think I posted in the room. Look for bullish signals around 93.40. Okay, she made a 93.42 low. So fib Elliott Wave was quite kind to us on that retracement. So we're then looking for bullish signals. Okay, you could potentially take your bullish signal off the hourly chart. Okay, wait till it breaks above the moving average, or wait till it breaks the high. But we want to get in at low risk reward. Okay, we want to get our risk as minimal as we can around this base. So we then take it down to 5-minute time frame. This line here is that fib level. Okay, 93.42 is the low. Let's see if we can zoom in a bit. Not really. An inside bar. And what do we say about inside bars? Inside bars are areas of indecision. So we get an inside bar, we get a break of the high, and then it moves up. Okay, you could have been extremely aggressive and entered here, or you could have waited for a higher low. So here the higher low confirms. What I also look for a lot of the time, just to confirm a trend, whether or not, obviously if you're not really looking at it as a trigger on 5 minutes, but on the hourly chart, if the RSI breaches the 50 line and she's moving up, okay, against, this is the Ishimoku cloud, these are my moving averages, okay, so we're bullish here, we've got a bullish crossover, which I don't use as triggers, by the way, I'm just looking for support and resistance levels off the moving averages, but we're higher, okay, we're above 50 on this RSI, and you can note when she comes down in this fourth wave, she's still above 50 on the RSI, so I know that she's still bullish. And we get this inside Arami candle, okay, we get a higher low. So that is the opportunity to start looking to build a long position, okay. And here, an entry of 1 unit on the close of that candle. So your stop loss, where's your stop loss going to be? Aggressive can be underneath here, underneath 93.42. Not so aggressive can be underneath the fib level. I don't understand that question. What look back do you use? What do you mean by look back? And I don't use RSI for anything else. 15 is my is the setting that I have. I don't use RSI for anything else apart from a bias. I don't care about overbought, oversold. I might look at divergence, but only if I've got a wedge formation and I just want it to be confirmed as a visual. It's giving me a bias. Same thing with moving averages, same thing with Ishimoku. I want it to give me a bias. I want them to tell me that I'm looking at the right side of a trend. I don't pick the tops and bottoms. I can't. I'm not any good at it. What I look for is trend. So here, this is our first long unit at 93.50. Okay, I'll stop at 93.40. So aggressive underneath that that pin bar. So potentially a 20 pip stop. I didn't have a 20 pip stop. I had a 10 pip stop. I had a 20 pip stop on this entry. So underneath the fib level. Okay, she then breaks the previous high here. And this candle is a bullish engulfing. Okay, so that shows us it completely engulfs this previous candle. A bullish engulfing candle. So we buy another unit at the high. Okay, I always wait for a candle to close. A candle is not a candle until it is finished. Those who buy on, sometimes it can be quite painful because obviously if you're looking to buy the break here and you've got to wait until she ends up here, then you've missed quite a few pips. But it's so dangerous to just blindly put your profits, your trigger level above breaks, because what invariably happens, it will just spike up, take out stops, triggers, etc., and then come back down. For me, it's a far better way to trade, to try and buy in on pullbacks, okay, and add in on breaks. So here, enter long, second unit after the bullish engulfing. So I average now 93.50 and entering long at, I did do the calculation, I'll show you in the end slide. So entering long at the end of this candle, we've now got 2 units with an average of 93.83, okay, and that's where we place our stop. So we've bled this one. This one's got us into the trade, okay. We've got a bleeder, it's hemorrhaging. So it moves up, and we're using that profit for our stop. So to enter another unit here, as long as the market doesn't break through this midpoint, which would basically mean that it's taken out this point of resistance. This is a point of resistance. It then becomes a point of support. Once the resistance is broken, it is then support. So we're just underneath support. We know we've got, a fair bit to play with. Plus, we've got a very bullish candle. So our entry, or our average, was down here. As she breaks higher again, okay, another bullish engulfing candle. If you wanted to, you could have bought another unit at the top there and scaled it even more. We didn't look to do that. Inside a Rami candle with a confirming candle for me here. So close one unit, 94.54, okay, for a total of 69 points. The stop is then under 94.04. So managing this trade as she's moving up, taking a bit off, moving the stop to a higher level below a bullish candle. We know we've banked some. We've got 69 pips in the bank, and if she goes down and takes that stop, then we're going to get another 21 pips. So worst case scenario, we've got a 90 pip trade there. Scaling in seems very hard psychologically. I have a poster on my wall, which I've actually made myself, from a very good book that I'd recommend called Trading in the Zone. And it basically, he talks about, some of you have read it probably, he talks about money management and psychology, about a trader's edge, sticking to what you believe. And basically it says anything can happen. You don't need to know what is going to happen next in order to make money. There is a random distribution between wins and losses for any given set of variables that define your edge. An edge is nothing more than an indication of a higher probability of one thing happening over another. And the last one, which is the most important, I believe, is every moment in the market is unique. Okay. What we're looking for in all trading is a bias. Okay. The trends, the bias. What happens normally when that happens? If a wedge formation happens, what normally happens? It normally breaks to the downside. Not every time, but that's what normally happens. A bullish engulfing candle, what normally happens after a bullish engulfing candle? The market moves up to the upside. We know where support is, we know where resistance is. So you've got to focus yourself. You've got to, you've got money in the pot. You've got to try and maximize your risk. You don't want to be putting £10 on to win £10. That should be your minimum. So here, reinstated long, 94.74. It held the moving average support, with a bullish engulfing candle. Okay, so reinstated the long. The average then becomes 94.28 on a bullish engulfing. Stop loss 94.37 below this potential trigger candle if it had come lower. Okay, and then let's just pull that back a bit. Anyone who reads about Elliott wave theory will be aware of fifth wave signals. Okay, as the market starts to come to an end, and this isn't a great wedge, but as the market starts to come to an end, if you think of a coiled spring, okay, buyers are still in control, but the momentum, which is what we want in a bullish momentum in obviously an upward market, bearish momentum in a downward market, the momentum is starting to slack off as we're moving higher. So we're still making higher highs and higher lows, but not with any real conviction. Okay, and the break of the wedge is here, 95.25 with divergence. Okay, and that is basically the end of that upward movement. And as we knew, or as we've seen today, after the Swiss National Bank meeting this morning, you'd be very brave to be holding the position into it, or at least a full position. Talking about not increasing their intervention, or the level that they're looking to intervene in Euro Swiss, and obviously Swiss got bought quite aggressively. So the first unit 69 pips, second unit 2 and 3, averaging 94.28, out at 95.25, 194 pips. Total potential profit would have been 263. A note here as well, when you're sort of saying, oh, you know, would you got out at that level? Worst case scenario would have been here. I use this a lot. I use the moving averages a lot for support and resistance. Okay, so I'm noting the wedge when it breaks through, and then it breaks through the moving average. I'm no longer in a uptrend as far as I'm concerned, and obviously the RSI breaks through the 50 level. And just look here, the whole this time, if you're worried about overbought, oversold levels, you'd have missed numerous opportunities, but it just stayed above the 50. It's called trading in the zone. Okay, we've got 10 minutes left. Should we have a look at some charts quickly? Because I don't think this is going to be recorded because of the diabolical software that I've got. Right. Can we see that, guys? It's a gold chart on at the moment. Can anybody see that? Yeah, great. This was one of the trade recommendations this week. We covered gold and crude oil on a weekly basis, so we recommended a sell. This is on the back of, or it was on the back of, aggressive move off what looks like a three-wave correction, move back up, engulfing candle off the high, and move back down. I still think she's very bearish around to this sort of level, 145, the figure. Let's just have a look at some others. Okay, Aussie dollar. Go through them all actually. 10 minutes quickly. These are not trade recommendations, okay? I'm just telling you what I see. I don't think I've done Aussie dollar actually. This is the weekly chart. Bit messy. Just coming down to 61.8% support on the weekly. Daily, now this looks impulsive, and to me this looks corrective. Okay, there's no signal to get long yet. There's no bullish reversal candle here, and even taking it down into shorter time frames. At the moment, it looks corrective. It's in between. It's chopping around the 50 level. How much does fundamental bias into? None whatsoever. I know what's going. The market will tell you which direction it's going in. Technical analysis to me is, I have the news on, but I don't trade it. Okay, crab pattern is 161.8%. So triangle formation, the right wing, or 161.8%. What is happening today? This isn't a test, but can anyone see what's happening today? It's an inside candle. Okay, so investor indecision. Now, again, I know somebody's just said, John T, that he's bought some here. very brave after a very aggressive move down. I haven't got any signals to get along yet. Even sort of taking it down into shorter time frames, 60 minutes. There's an engulfing off the bottom, off this 161.8% level. Potential double bottom formation, but there's a lot of resistance to the upside. I'd be more bullish than bearish on this pair now, off the back of that inside candle. Cable. Broke the low, potential double bottom. Again, what have we got? Investor indecision. We've got an inside candle forming today. No comment. An inside candle forming today off a double bottom with divergence. So potential to the upside, definitely. So we break it down in shorter time frames. What do we see? We see resistance here, cloud resistance. Okay, so it's moved up, got higher low. We've got a potential head, a potential left shoulder, potential right shoulder, and a neckline. It looks very, very good for a head and shoulders breakout, but it has to break this level. What will happen tomorrow? It's too late today. What will happen tomorrow if she breaks this neckline? She will break out of the cloud. So all of this is your resistance. Okay, sorry about that. I'm going to get rid of that. So all of this is your resistance. As she breaks that cloud, that resistance will be cleared. And notice how she's just messing around still with the 50 level. So she's not confirming that she's bullish yet, but decent signals. Inside candle, confirming candle. A higher low. We haven't had a higher high yet. Maybe we suppose we have, if you count that. Okay. And there's the neckline. So potential for a decent upside run. Okay guys, it's 5 o'clock. I've been at it since 4 o'clock this morning. So that's me done for the day. Any questions before we wrap it up? Obviously, I don't think this presentation will be on the FX Street website because we had issues with the software. Any questions at all, guys? I'm sure I can have more time, Jack. My wife will kill me. I've been at it 13 hours. It depends what signals I get. It can be anything from 0 to 15, 20. That's personal. That's not through First for Trading. First for Trading, we cover 11 currency pairs. Okay, the morning calls go out at 7 o'clock every morning. Buy, sell, or trade a break calls, always stops, projected target levels, etc. You're welcome, Kaz. No, is the answer to that. I'm actually bullish. I'm long-term, very long-term bullish on euro dollar. No, we've never 15 trades at the same time. My good God. 3 trades at the same time? Yes, I think there'll be a few to go. Whether or not they will then drop out and go back to the drachma, or I'm not quite sure. A lot of the broking offices in London are preparing for a drachma desk. So it could well happen. They're normally in front of the curve, as they say. Euro dollar, if you look, you probably think I'm completely balmy. If you look to a monthly chart, by the way, you can't trade off her. Well, you can. You'd have to be pretty crazy. It's a potential pendant. It needs to break the high to confirm that, and it looks extremely bearish at the moment. We're waiting to see. Okay, guys, I'm calling it a day. Enjoy your evening and enjoy your Christmas. We're now finished until the 3rd of January, so there's no more webinars for me. I'm taking a long break. I hope you've enjoyed it. Thank you all for turning up. More than I expected, to be honest, because nobody really likes talking about money management. And thanks to FX Street for letting us host on their site. Okay, guys, have a good one and take care.